Hi, you're watching Managing Money with Money Control. I'm Sakshi Patra. While last week we talked about the importance of asset allocation, today we are going to be focusing on profit booking. There sure is a right way to go about it to avoid losing out on great returns and to know when is perhaps the right time to book your profits. To help us know all about the art of profit booking is our personal finance expert, Rohit Shah, CEO, Getting You Rich. Let me begin by asking you, how important is profit booking considering that we all want to make money from equity and debt markets?
Hi, Sakshi. The answer here depends upon what asset, what instruments, what kind of vehicles that you're invested in. It also depends upon what role you are playing. So whether you are a long-term investor or you're a professional a trader, you're kind of doing a short-term investment, you're like doing a swing trading. So the answer really depends upon what's the objective, and whether you are investing in kind of real estate, you're investing in stocks, mutual fund. But if you are a long-term investor and if you are kind of looking at some goal-based investments, we think that the profit booking should be seen in the perspective of how much of the goal that you realized, when is the goal due, and from that point of view, what we are saying is that profit booking is actually an outcome of the goal achievement.
Now, Rohit, many of us are happy to see our money grow over a period of time. However, when you book profits, you get the money back in your hands. Is profit booking more important or profit accumulation is key?
So let me tell you an interesting story here, Sakshi. In one of the book, Mary Buffett and David Clark gives an example of Warren Buffett versus Benjamin Graham. In 1973, Mr. Buffett invested about $11 million in Washington Post. This investment in 35 years, in 2008, reached to around $1.4 billion. Compared to this, if you look at how Graham would deal, amongst the many rules he followed, one of the rules Graham had is the moment a security reaches a 50% profit, he's out. He'll sell, he'll book the profit. So what Graham would have done, $11 million becoming $15 million, he would be out, he would sell, and he would also pay 30-40% tax on the gains. Whereas in the case of Buffett, he did not sell for 35 years, and from $11 million to $1.4 billion, and he still not paid a single rupee in terms of the taxes. So we have to see this from the point of view of accumulation being more important to help achieve your long-term goals, and depending upon where your goals are, we would argue that profit accumulation is more important.
Let's discuss two situations, Rohit. One, profits accumulated over time may get wiped out if markets actually crash. And on the other hand, when you book profits, especially very frequently, you tend to spend the money away. What do you advise investors must do?
Right. And I would agree that, this is a debate, this is not a settled issue. In many words, this also tantamounts to kind of timing the market, looking at various parameters and taking that call. And I would take a kind of step back and look at from an asset allocation framework. Once again, referring to someone like Roger Gibson, he says, Mr. Market Timer, to be successful, he needs to be right 3 out of the 4 times. Because taking a call on the kind of when the profits look good and to sell off is probably not that difficult call. But when you go on a cash and you're waiting in the sideline, it's very difficult call to kind of be right that now the U-turn has happened and we need to swing it back. We think that being a very difficult job, Mr. Buy and Hold does a much better job in a general framework. We also need to consider the impact cost, transaction cost, capital gains, and the kind of time and energy that is getting spent. So in general, we would think that it may not be a good idea to try and book profit, to try and kind of take out and look at it from a point of view of where you are with your asset allocation, where you are with your goals, and where you are with your long-term articulated objectives.
So how frequently should one book profits? Also, is it any different in the case of direct equity shares as opposed to equity mutual funds?
We think that profit booking could be an outcome, and the objective should be seen in terms of what goal one has. So to give an example, in a asset allocation framework, we normally recommend that once in a year you should rebalance your assets. And in many ways it would also mean that if your assets have grown higher, then you will end up actually booking the profit. I would say that it is a once in a year doing this asset allocation exercise is a good idea, and it also kind of results into a profit booking.
Well, many financial advisors advise to invest to reach a particular financial goal. Is profit booking a part of the journey to reach your financial goal, or does it actually disturb our path to financial goals?
So Sakshi, as I said, we think that profit booking is not actually so much so an objective. It's an outcome, and it's essentially the goal that is what is being focused here from a financial planning point of view. And then if you think about it, take a step back. How the financial goals are done. So there is a certain amount of target corpus, there is a certain amount of money that is getting invested, and there is a certain amount of rate that is getting assumed. So for example, if you are talking about a 12% CAGR or a very long period of time, the course correction would need to happen in case if you are not meeting the target. But from a goal planning framework, we really don't look at it from a point of view of how much profit is achieved vis-a-vis target, and does that make sense to kind of book the profit. In any case, if you are using an instrument like a mutual fund, it depends upon what kind of objective and the kind of design the mutual fund has. But in that case, the fund manager, whose expertise is called in here, and he's the one who takes the call to kind of sell or hold at a required point of time. If you're investing in an instrument like a direct equity, then hopefully it's a bottom-up approach, and you probably have a target intrinsic value, and in that case, if you've achieved the target, it may be a good idea to kind of book the profit. So again, the answer to that depends upon what instrument you have in mind. But from a goal planning point of view, what we really focus on is kind of the target goal. And of course, before the goal kind of comes near to the completion, typically about 2 years before, we would advise that you start moving to a relatively safer instruments, so that the goal is protected.
And lastly, Rohit, what are the rules you follow when it comes to profit booking in debt funds?
Sakshi, we feel that in a debt, on a real basis, there's not much profit really. It just kind of beats inflation. So the way we would look at debt is again same from an asset allocation point of view. In case some investors may have kind of expanded balance sheet, have surplus wealth beyond achieving goals, and with a high risk appetite, they might suit to kind of dynamic bonds or accrual strategy, duration strategy. And again here, I would assume that they would invest through a mutual fund, and it's the fund manager who would take that call. So that's the way we would play debt.
Thanks a lot, Rohit, for sharing all these tips and ideas. And with that, it's a wrap here. You can write into us at moneycontrolpf@nw18.com and send us your queries. Stay logged on to moneycontrol.com for more insight on personal finance. Thanks for watching.